morning, everybody. Thanks for coming out. My name is Trent Mell, CEO of First Cobalt. Got a couple of members of my team here with me as well. So thank you for coming. Cobalt's been it's been a fun ride, up, down, and now we're coming up again. This morning, Macquarie mentioned pegged Cobalt as its top pick for the next 12 months. 2 days ago, Morgan Stanley did the same thing, copper and Cobalt, and a week or two ago, Citibank that was out. So Cobalt went on a wild ride from $15 a pound. 2017 and 2018 went up to $43 a pound, a decade high, and then had the typical sort of boom bust effect, brought it down to $12.80 over the summer, and we sort of sit here today at about $18 a pound, and the long-term forecasts are back up in the high 30s. And so I want to take you through our story. I want to take you through Cobalt. To get behind this company and this story, you really have to buy into the electric vehicle thesis and this fundamental change that we're all going through. You'll hear from a lithium story next, Standard Lithium, and it's the same thematic. The world is changing. I bought a Tesla a month ago, and it really is a phenomenal ride. And this company was founded 2.5 years ago on this macro belief that the world is undergoing a big change, and the strain that is going to put on the raw material supply chain, maybe another couple of years out, is almost unprecedented. And the world has never seen a mining community going hunting for Cobalt's sake. We've always taken Cobalt as a byproduct of nickel and copper operations, and we sought to do something a little bit different with First Cobalt, and I'll tell you a little bit about the journey, and more importantly, where we've landed more recently with a strategic relationship with Glencore, the world's biggest cobalt miner. So there will be, of course, some forward-looking statements. Why Cobalt and why First Cobalt and why now? I've kind of gotten into it, but we're essentially a year away, potentially, from cash flow, first cash flows, if things continue to advance the way they have. And with that, it gives you really access to the electric vehicle market revolution, and it gives you great leverage to the Cobalt market. As I said, we haven't gone looking for Cobalt as a pure play thematic, and if you're going to try to invest in Cobalt, you're hard-pressed to find a vehicle. I'd like to talk to you a little bit about the cash flow opportunities and the leverage we're going to get also from our exploration assets. So here's the current board. I will say, gentleman on the end here, John Paul Lassalle, is going to be becoming our chairman next week. John ran Valley Canada's operations, including their smelting operations, in a past life. He's got a pretty long and storied career in the operational side. And so as we've gone from sort of creating a company to running a business, we're retooling our team. And Paul Matisek is going to go off and he started a new venture. He's our startup expert, and we retooled our board a little bit with Henrik Fisker, of course, as a automotive icon, design legend, the BMW Z8, Austin Martins, and he's starting his own company. And so our board is kind of a eclectic mix of business people, EV, market types, and conversely, our management team, we all come from an operating background. Myself, I started at Barrick Gold, Sherritt Nickel thereafter, North American Palladium, Rico Gold, and I've been in junior mining really over the last decade. When I did that transition, it's higher risk, but frankly a lot more fun. And same with the rest of my team. First Quantum, Falcon Bridge, Innet are some of the companies we've worked for in our past careers. A little bit about our company. We got about $7-8 million in the bank right now. A lot of that earmarked for work that we're doing on a refinery. Market cap just over $60 million. Very liquid. We got coverage from Canaccord and 8 Capital. So who we are, so we started the company 2.5 years ago. Initially, we were all about the what's known as the Canadian Cobalt Camp, up 5 hours north of here, near Cobalt, Ontario. Historic mining camp, 1904. It was our equivalent of a Klondike Gold Rush, 100 mining operations, high grade, small underground deposits. We consolidated that camp with a view that maybe there was an opportunity to do a big land play, but ultimately a larger bulk disseminated open pit mining opportunity. We still continue to chase that, but as the cobalt boom of 17-18 continued, we also acquired an asset in Idaho, which is more advanced. We've got a resource on it. Every hole is hitting mineralization, and that became quickly our flagship in terms of our mineral projects. All the while, we had this refinery also in the Cobalt camp that we continue to advance. And over the summer, we started talking to Glencore and struck a deal with them to restart, expand, and finance our refinery. Consequently, that is our primary focus in the days ahead. And as you look at the blue stripe going across, it speaks to the catalyst coming up. We've got a field crew that's hitting the ground next week to work on a feasibility study. Feasibility will be done in Q1 of next year. And once that has been done, assuming we get the go-ahead, we could see that refinery up and running again on the current flow sheet in 12 months from today, with a significant expansion 12 months thereafter, and the cash flows that go with it. So the vision for our company is, quick path to cash flow, use those dollars to advance our Iron Creek asset and other exploration assets, continue to grow the business. And so I'm going to spend most of the time talking about the refinery because that really is the value proposition for us right now. The refinery is a permitted hydrometallurgical facility located just outside of the town of Cobalt. It was commissioned in 1996. It's been on care and maintenance for about 3 to 4 years now. But for those of you who know the miners, most of this room, you've got a mining background, understand what the business is about, that the permits are invaluable. And when you get an asset like this, with the permits in place, to try to replicate that anywhere in North America, you're talking many years of waiting and delays and consultations. And so we acquired this as part of our three-way merger into the Cobalt camp. We started doing work and looking at this as, what could it do to become a regional processor for the continent? And an important attribute of this facility, hydrometallurgical facility, yes, is it's got the permits to treat arsenic. And almost every deposit we see here in North America today has high arsenic contents. So high, in fact, that you can't even ship them to China, which is where most of the refining capacity, installed capacity is today, because it violates their import limitations. This is the only refinery in North America, Cobalt Refinery, and it's permitted and ready to go. When it did produce, it was taking in feedstock, custom feedstock, high arsenic, running at 12 tons per day. What we've been doing with Glencore is trying to identify its application for the most abundant feedstock on the planet, cobalt hydroxide, and that's the material, that's the byproduct effectively being produced from the copper mines in the DRC. All of that product today is finding its way into China, and so in an era where we've got a trade war going on with the US, we've got 25% tariffs on cobalt imports going into America, we've got no other viable supplies of cobalt to go in to that market. We've got this facility sitting here in a free trade zone, able to provide that supply, and it's led to a couple of visits to the White House and some great support on Capitol Hill to get this refinery up and running and to provide an alternate source of critical minerals in North America through the current supply chain, which is DRC and China. And so here's the facility. And so over and above the permits, we've got a market cap of 60 million. We've got a replacement value of about 100 million Canadian on this asset. And when you look at it, when you look at the work we're going to be doing, you'll see the roads are there, the tailings facilities in place, the building is in place. You can see the power lines running to the property. The building's in great shape. And the work that we're going to be doing with Glencore, it's about a $40 million capex. Everything we're doing is in the four walls of the building. And so when you think about an execution risk on a mining project, the first thing you got to worry about is the mine plan. Is what we're getting out of the ground in line with what we thought we were going to get. Thereafter, you got to worry about the permitting delays. Thereafter, you got to worry about the capex creep of running power lines and building roads and pouring concrete. None of that is a factor here. All the work we're going to be doing is in the four walls of this building. And I think this picture really portrays it. This is our property. So when you look behind, flip it around the other way, this is all land that we own. In looking at the Glencore feedstock, we don't have the arsenic issues. So one of the things we're trying to look at to be a little more progressive and in keeping with the times is dry stack tailings that we put in this corner here in the field. So the game changer for us happened last spring. We got our hands on some cobalt hydroxide feedstock from the DRC, and we put it through a leach test with SGS. And recognize that this was much easier to treat than the historic feedstock we were taking into our refinery. And so in replicating our flow sheet in the refinery, SGS on a first pass bench scale test was able to produce a high purity battery grade cobalt sulfate material. The impurities of a 0.04 are quite low, and the detectable elements that we found in them were, for the most part, below the limits required for battery grade cobalt sulfate application. I would say that every battery company has a slightly different specification. So when we go forward, you'll need to tweak your flow sheet to target a VW or a Tesla or whomever we would end up with. But once we did this, we all of a sudden got the attention of the big miners. And it's not just Glencore. There's ERG, there's the Chinese. You can pick the big miners out there. For the Chinese, this was a way to get around the tariff wall. And for the non-Chinese, this was a way to ship their product anywhere but China, which was causing its own problems as the market went down in 2018. And so we started a bit of a process, a global process around the world. I found myself in Shanghai meeting with the miners. Glencore was an obvious partner, and frankly, I couldn't be more delighted that we landed with them. They are the Goliath, there's no question about it, and they're fantastic negotiators. Having said that, when you do a deal with Glencore, and I've done deals with them in previous lives, they do honor their contracts, and they will work with you. But they'll grind on the commercial terms, and we're in the middle of that now, so stay tuned. So here's the facility, and once we had the metallurgical tests done, the next thing was to do a scoping study of the refinery. So assuming this flow sheet and this product feedstock, what could the refinery do? And so we went to Ausenco for the scoping study and said, look, assuming we use all the infrastructure currently in place, assuming we use our refinery, which is this building here, but then we allow ourselves to expand into this warehouse. It used to be an old building. What can this facility do before we have to knock down walls? And it took us from the current operating scenario of 12 tons a day to 55 tons. In part, the nature of the material, we're leaching it. We don't need to use our autoclaves, which is the bottleneck for the current flow sheet. And secondly, we're expanding into this area here. And so what it means, throughput of 55 yields 5,000 tons is about 11 million pounds of cobalt per annum, assuming a 30% grade product and a capex of just under $40 million. And so it was with the metallurgical results and its flow sheet that we were able to conclude our initial contract with Glencore. And the backdrop, because of course the question is going to be, Trent, what does that mean from a revenue perspective? I think it's best to think of the future for the next few years. Glencore wants to provide the feedstock. They're going to take the offtake, and the offtake is what's going to fund the capex that required. So it's going to be a loan to be paid through the offtake. We will be a toller for the first few years, but if you want to look at the opportunity and what this looks like long term for the refinery, you have to really look to the DRC and to China. And so what happens here, the miners in the DRC will produce the copper cathode, which they can sell to a market, and then they'll produce the hydroxide, which goes to China, and they're paid a payability factor. They're paid a percentage of the cobalt content in that hydroxide. And it varies on average 65 to 75% of the cobalt content is what they end up getting paid. And so assuming a fairly modest price increase from $18 to $20, 18 today to a $20 assumption on the same kind of production profile that we envisioned for our refinery, you've got a gross metal value here of about $220 million, which would yield on a 70% payability factor $155 million of value to the mining operation for capex and opex and their margin, and then the balance ends up in the refiner's hands. And this is what Glencore is not capturing today. They're selling hydroxide, they walk from it, and they are traders, so they don't get to trade the units thereafter. And when you translate that into what that means for a refining operation, well, our annual estimate on capex is about $26 million. You're left with a residual of 40. So I caution you, this is all illustrative of what the pie kind of looks like in a DRC China situation. Our own scenario likely will be paid a per pound fee for refining in our early years until the debt's repaid, but this is kind of a model we would see ourselves evolving to over a series of a number of years. So what does the deal with Glencore look like? It's a $5 million injection that's already been made, and with that we've taken the scoping study and we're trying to get to a feasibility study level. So we've got a Senko and SGS, 9P sold, and that study is already underway. Field crews are hitting the ground on Monday. SGS has already started the metallurgical testing, and we'll have our feasibility study in Q1 of next year. Once we have that in hand, then the idea would be to move forward. And the operational scenario that we are envisioning is to use the current permits, which is the 12 ton a day scenario, and just do the quick restart, so that by this time next year I can stand in front of you and say we're now commissioning or we're operating at a 12 ton a day scenario. Modest margins at that level, but when it gets you comfortable with the flow sheet. Think of it as a giant pilot plant, and a pilot plant that's yielding a product that we can then send to an auto company or a battery maker and have qualified as a viable product for their battery specification. While we do that, we continue with our permitting and engineering and construction of the 55 ton a day scenario. And so from about 18 months or so, 18 months to 2 years from the delivery of the feasibility study, we would expect to see ourselves at the 55 tons a day scenario. Good margins, and that would fund us there on a go-forward basis. And so what does that mean in the global context? What is the cobalt market as a whole? Bloomberg estimates that if we execute on our plans, we would be the 4th largest refiner globally outside China, with about a 5% market share, just behind Glencore currently, which produces or refines about 6% of the market. Importantly, Glencore produces a metallic cobalt. They don't produce a cobalt sulfate, so it is a different product for them. But it's not a bad place to start given where we are today. And this I won't spend time on this. These are the different restart scenarios from 12 to 55 and the studies and timelines to get us there. And then in the presentation, if you have it in front of you, you'll see a detailed schedule on the work, well, fairly detailed schedule on the work we're trying to get done and what that could look like, permitting and engineering and production scenario. And so just a moment on the cobalt market. It's a small market. It's often misunderstood. It's obviously linked to the DRC and China, but it's a part of the EV market. Glencore made an announcement about 8 weeks ago that really turned this market around. They said we're going to shut down our Mutanda operation at the end of the year. Good old-fashioned supply management on the heels of the record prices that have resulted in a high level of artisanal production that flooded the market. The artisanal production has fallen off a cliff over the last year, but supply issues remain. And so Glencore has taken the long-term view that they're not going to put their product in the market at a low price. And in so doing, the cobalt market has gone up about 40% in this basically about 6 or 8 weeks. I would say the juniors, like ourselves, have not yet responded. I don't think people have noticed. But the trend is there, and it's caused a lot of the big banks to revise their forecasts in a fairly aggressive fashion over the next 12 months. But here you can see that more than half the production is coming out of 5 operations. All of them are situated in the Congo. And that speaks well to the assets that we have in North America and what we think we can contribute in the years ahead. And what it means, and I've talked about this already, but what it means in terms of the rest of the supply chain. China's got about 60% of global refining capacity. The other 10% here in Finland is actually taking Chinese feedstock. But when you start to look at the sulfate market that we're planning to play in, China is by far the dominant player. That's 80% of the sulfate refining capacities in China. So we really are a viable alternative, and the only alternative for North America over the short term to provide a different source of supply chain. Supply and demand, there's all kinds of projections here of what that looks like. The red bar here is supply of refined metal relative to the demand stacked across the different applications in the lithium-ion battery space, including buses and storage. And then the U.S. We often think of the U.S. and North America, frankly, as being laggards in the EV space. That's starting to change. There have been a few battery plant announcements, construction that's going to be moving forward the next 2 or 3 years, and very quickly the U.S. will become the second largest battery market in the world, which is a far cry from where we were even a couple of years ago. So very quickly on the assets, not to diminish this, but I mean, I think the catalysts for us really are on the refinery side. I love this asset. When we went looking around the world, Frank Santaguida at the back of the room worked at First Quantum, lived in the Congo, Zambia. We knew the assets. We looked there. It's no place for a junior. It's hard to work there as a major. And we started looking in Sweden and Chile and elsewhere. And this is outside of Morocco. This is the one place in the world where you can find a primary cobalt deposit. As I said earlier, most cobalt's coming out of nickel and copper operations here. A rough revenue split for us, about 70% cobalt and 30% copper should this go into production. So we found ourselves in what's known as the Idaho Cobalt Belt. Historically, there was a really big cobalt operation run by Miranda, now owned by Glencore, called Blackbird. Right next to that, we've got one of our peers, used to be Cobalt, now Jervois, with their Idaho Cobalt operation project, and we've got our asset nearby, which is not quite as advanced, but very different, great continuity, big intercepts, and we're about 60 kilometers away in a pretty good belt. 3 minutes, I'll do 1 minute. So here's where we are. Here's the resource we put out last year. Here are the targets for extension. We didn't go too far. The market started to pull back in 2018, so did we. We went from 4 drill rigs down to 1 in the space of about 2 months. We did a bunch of infill drilling. We're looking to bring an updated resource into the market, which is going to be more of an upgrading of the inferred to indicated. The tonnage piece, it will follow. We've got all of the drill pads and roads built to do this extensional drilling. As I say, every hole here is hitting mineralization, 30 to 50 meters of width, and some of the thicker intercepts. And so I would view this, although we've got potential open pit underground mining scenarios, I would view this as a fairly high grade underground deposit that would be bulk mineable, subject to, of course, a lot more work and engineering. And then lastly, the Ontario Cobalt Camp. Again, great asset, very different style of mineralization. High grade, small deposits. The dream, the vision here really is a bulk mineable disseminated ore body. We've gathered a lot of evidence over the last year. We've got a lot of work to do dissecting the data and trying to move it forward, but at the time being, this is going to have to remain an attractive but inventoried asset while we focus on our top priorities. So I will leave it there. Well, thank you for your time, and welcome to questions that I have. Yes, sir.
Yes, I'm just wondering, how far are you from Sudbury, your cobalt?
That's actually a good question. Yeah, so we're about 2 hour drive from Sudbury. So we've got North Bay would be the nearest community, nearest town, but an hour and a half, I suppose, conveniently in the riding of Minister Vic Fideli. But the Sudbury gang, you got XPS, Strata Process, or Excellent Process Service, I guess they call themselves now. Their Met group and all the operational folks from Glencore over in Sudbury have been extremely supportive, and that'll become an important ally for us going forward.
And doesn't all those nickel mines in Sudbury, don't they produce cobalt too?
They do. In fact, I used to work for a company called North American Palladium, and so you would have palladium, platinum, and then it was nickel, copper. Gosh, I think there was gold, silver, and a little bit of cobalt. And Sudbury Basin, very much the same, right? You get your nickel, you got copper, you got cobalt, and these polymetallic plays. Cobalt's not huge, but it's not insignificant either in the Sudbury Basin.
And I thought there was a town called Cobalt near Sudbury.
Correct, yeah, that's in fact where we are. We're actually in North, what's called North Cobalt.
Oh, I see.
But yeah, it's Canada's, with Sudbury perhaps right around, it's Canada's, one of Canada's oldest mining camps. It's a gem of a place to go and visit. There's a mining museum there. Agnico still has a lot of land up there, 100 former operations. You shouldn't do this, but there are attics you can walk through. Mineral sample. It's just a fact. If you like mining, it's a great place to spend a day of the summer.
Thank you.
All right, time is up. So thank you, everybody.